there any chance you have Professor Walker number? Because it's asking a code, and I sent him a mail, but I don't know how.
No, I don't have it. I don't know. He hasn't sent me a number.
Why is that doing this? Because usually it always logs on this computer, so I don't know why it's asking the new verification code.
It might be the account. Is it the guest account?
Yeah, it might be on the guest account.
You know, credentials to log in?
No,
Okay.
I only know it's Zoom.
Is he contacted you to give you the
I sent him a mail. I don't know how fast can he answer.
Okay. He hasn't sent like a meeting link.
No, but the worst case, I'm logged on my own laptop. The worst case, but this is not.
Thank you, yeah.
I think it's somewhere else.
You have is there a presentation in the meantime?
Sorry?
Is there a presentation to upload in the meantime?
The PowerPoint?
Yeah.
It's up to Professor Walker.
Oh, is he the one presenting?
Yeah.
Okay.
Is it going to be easier then to do what we did last time and to log it on mine?
No, the issue is that I'm logging in. It's supposed to be easy, but it asks a code that has been sent to Professor Walker phone.
Not us.
And if he doesn't send me the code, I can't log in. So I asked him.
And the one that just got sent to him is expired.
Okay.
You have to resend one, but it lasts for a minute.
Oh yeah, I enjoy that game. The security settings on my emails mean that I never get my codes in time to be able to use them.
Worked.
It works?
Yeah.
Good.
Yes. Okay, I guess now it's.
So are you sharing your screen, or would he be sharing his screen?
I'm going to share that. I'm happy.
Sharing his
So where is the slide?
The site?
Yeah, there should be some slides because that's how we're doing it, isn't it?
Yeah.
Yep.
I mean, you have your own site or
No, I'm going to. They should be uploaded here because they're.
on Campus?
Yeah, I think so.
Or it should be. He's not logged here. It's kind of not convenient.
If not, do I email them to you? And you upload them, or is...
It's the guest account.
Yeah, the guest account is not logged.
Probably best to email. And then access your email and then bring it up. I think the professor said he can email it to you.
I can email it to you.
So if you open up your email in the meantime, and the PC, so
Maybe I can send.
oh, you have it here.
Is there a USB key here?
And
There.
Yeah.
That's just the port.
Yeah.
Yeah, it's a port. Are they?
You can send it to your email, log into your email, and then log back out after you've uploaded the presentation.
Yeah.
I would have to go up to the 4th floor to get a USB if you need one.
I'm afraid I've only got USB-C with me, not USB-A.
But this is the right one.
Yeah.
This one.
Yeah. Just
Okay. So can I do?
There is a USB-C port
Is there?
on the PC itself.
Oh, is there? Oh, if that's easier then.
Like this. Oh yeah, there's one. So in that case, maybe you can just like
Let's try this then.
download it and slide it inside.
Professor George joining online or?
No, it's not gonna be there online.
Oh,
He just lets me get on with it.
so it should be just underneath the USB-A.
This one, yeah. Okay. Here, and just
Right, so there is.
Okay, I think this should be good.
Right, so.
Just
Users view only?
Yeah.
Okay. Fine.
everything's fine now.
Yep. Is that big enough? Doesn't look big enough to me.
See, if you oh yeah, you've got it.
Alright. Get rid of that on the left hand side. Okay. Start. No, that seems to
Cancel that, yeah.
cancel that.
To the Word.
Word down here.
Yeah.
But how do I start the recording up here? Okay.
Yep.
Record to cloud.
Cloud, yeah. Yes.
Cool.
Okay.
Afternoon. Imagine you go into a shop to buy a car. And the car salesman says to you, here is the information about the features of the petrol cars that we have on offer and the hybrid cars that we have on offer and the electric cars that we have on offer. What the person you are talking to has done is simply give you information in order to enable you to make a choice about what kind of car you want to buy. Now imagine that you go into the same shop and you say to the salesperson, I want to buy a car, and they say, well, how many miles do you drive a year? Do you do lots of long distance trips or do you only do short distance trips? And after asking a series of questions about you and your driving habits, the salesperson then says, I recommend that you buy an electric car because you only do lots of short trips and you'll be able to recharge it much more cheaply and you won't be affected by any international incidents that affect the price of oil, or at least not as directly. What has the salesperson done in that situation? Yeah.
Give an advice instead of information.
Yeah, you've been provided with advice because you have had a recommendation made to you that out of all the different sets of cars that are on sale, this one over here is the one that is most suitable for you. But what about this situation? You go in to see the salesperson. The salesperson shows you all the different types of car that they have available. And then, when you're having one of those horrible complimentary teas or coffees that they serve you in car showrooms, you then have a discussion with the salesperson. And during the course of the discussion, the salesperson says, well, it seems to me, based on what you've told me, that you're leaning more towards these cars over here because of these features, and you're ruling out those cars over there. Is that information still, or is that advice? It's tricky, isn't it? What if instead of going in and being shown every car that is available in the showroom, the salesperson has a conversation with you, you explain what your driving habits are, and they say, well, what I'd like to do is I'd just like to show you 3 cars. You know, we've got hundreds of them, but these are the 3 I think you ought to have a look at. Is that information, or is that advice? You think it's information? Okay, interestingly, English law struggles with that last category. But following the case of Rubenstein and HSBC, which you've got on the screen there, a bank or other salesperson is likely to be held to be giving advice whenever information is accompanied by a comment or value judgment on the relevance of that information to the client's investment decision. Or, and this deals with the category that we've just been thinking about, or the information that is provided is presented as the product of a process of selection by the salesperson involving a value judgment. So what you find is that in most scenarios where you're not dealing with a chatbot, but you are dealing with an interaction between an ordinary customer and an ordinary salesperson, if we've got an unscripted conversation that is taking place, it is likely to be the case that at some stage the salesperson strays from purely giving information and starts moving into the space of giving advice. And that is going to have 2 consequences in English law. One consequence is that English law for a long time has had this kind of binary distinction between information and advice with very different consequences. And it's only in the last few years that English law has tried to get away from that binary to something that's much more factually nuanced. The second consequence is because in practice it is so easy for a bank to stray into giving advice, the courts have had to use all sorts of different devices to restrict the consequences in which a bank is liable for giving bad advice. Because if you don't restrict the circumstances in which a bank is liable for giving bad advice, every time a customer takes out a loan and the loan doesn't work out in the way the customer wants, what's the customer going to say? Yeah, you gave me advice. If you hadn't given me advice, I wouldn't have taken out the loan. Therefore, I wouldn't have found myself in circumstances where I can't repay the loan. So the courts have got to kind of find some way of drawing a line. So in the vast majority of cases, the bank is protected. But in appropriate circumstances, the bank is held liable. So the case that really sets up this distinction between advice and information is Rubenstein and HSBC Bank. Now, what had happened in that case was this. Mr. and Mrs. Rubenstein had sold their home. And what they were doing was they had a pot of money that they were keeping until they found their forever home. Mrs. Rubenstein was pregnant, they were about to start a family. She, by the way, used to work for Deutsche Bank before she took maternity leave. Her husband was a solicitor. So they weren't unsophisticated purchasers of bank services. But they go to the bank and they say to the bank, well, we've got our money on deposit at the moment whilst we wait to try and find the home that we want. What we would really like is we would really like a better rate of interest than we're currently getting. But we still want the ability to withdraw our funds so that we're able to buy that home that we've always wanted when we found it. So you're clear about what it is that their parameters are. Well, what the bank says is, well, what you should do is get an insurance-based bond with AIG. And the person at the bank they're speaking to says the risk of investing in that bond is the same as putting your money into a deposit account. Now, in fact, the AIG bond was a bond that was invested in the money markets in circumstances where, hidden away in the small print, it said, in exceptional circumstances, we can suspend withdrawals. Now, the timing, of course, is everything. Lehman Brothers collapses in September 2008, the markets go haywire, and AIG comes in and says, right, okay, we're suspending withdrawals. We're suspending withdrawals from this fund for the next 5 years. You can have your money out now, but you take a discount. If you want to guarantee you get back the sum you put in, you need to wait 5 years. Whoa, 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 says Mr. and Mrs. Rubenstein. That is not what the bank told us. The bank didn't tell us we would find ourselves in this position. They didn't warn us about this. We've got something different from what we thought we'd got. So says the bank. We just gave you information about this product. You should have read the small print. We are not liable for the consequences of you choosing this product. The judge said, well, hang on a minute, let's just go back and go through the events again. The starting point is, what did the customer ask the bank for? What service was the customer asking the bank to provide? Did the customer just go in and say, please give me information about savings products? Or did the customer go in and say, well, as in this case, I want a better rate of interest, but given these parameters, what can you recommend? That is a request for advice. So says the judge, once you have a request for advice, a request for a recommendation, and by the way, a recommendation is really personalized advice. So, if I say to you, it's going to rain this afternoon, you should get an umbrella. That is probably just kind of generic advice. If I say to you, I can see you washed your hair this morning, your hair is going to frizz terribly if you get wet, you should go and get you should make sure you've got an umbrella, then that's probably a recommendation. Something that's tailored to somebody's specific circumstances. So the judge says, if the client makes a purely factual inquiry or reply that provides relevant information, it's doing no more than providing information. But if they're asking for advice, the bank will be held to have given advice and to be liable for giving advice unless the bank has provided an express disclaimer saying we are not accepting any responsibility for giving advice, or you can't rely on the advice we're giving, or our liability in relation to this advice is limited to pounds, whatever it is. The test, he said, was whether an impartial observer, having due regard to the regulatory regime and guidance and to what passed between the parties, would conclude that advice had been given. Adopting that approach, he said that advice had been given to the claimant. The manager at the bank had been negligent in recommending the fund. He'd wrongly said it was the same as a cash deposit. He hadn't attempted to consider alternatives. Now, in fact, AIG had two bonds that they offered. The one that he chose was the enhanced one that paid a slightly higher rate of interest, but it was exposed to this risk of withdrawals being suspended. There was a standard fund which offered a lower rate of interest, but genuinely was much closer to a deposit account in the way that it worked. So, you with me so far? Okay, this is then where it gets complicated. The judge said, I am going to award you only nominal damages because although the advice that was given was negligent, what happened when Lehman Brothers collapsed was so out of the ordinary that it wasn't a reasonably foreseeable risk. It was something that nobody could have predicted, and because there's not something nobody could have predicted, I'm going to find that the bank isn't liable to pay substantial damages. Mr. and Mrs. Rubenstein appealed to the Court of Appeal. In the Court of Appeal focused on one particular exchange of emails. It was an email from Mr. Rubenstein which said, we cannot afford to take any risk in the investment of the principal sum. In other words, we've got to be able to get our money back. That's our investment priority. Can you confirm what, if any, risk is associated with the product? And on behalf of the bank, the manager at the bank replied, we view this investment as the same as cash deposited in one of our accounts. So at this point, the judge says, or the Court of Appeal says, although the particular event that occurred wasn't foreseeable, it was an event of the kind of events, the category of events, that the bank salesman should have had in mind when responding to that question. The fact that you don't know which particular volcano is going to erupt doesn't get you off the hook if you're asked, what is the risk of a volcano damaging me and causing loss? Now, put a pin in that point there, because we will come back much later in this lecture to think about this question of how the courts have grappled with what kinds of loss a salesperson is liable for, or a bank is liable for, and what kinds of loss they are not liable for. So that was Rubenstein and HSBC Bank 15 years ago, followed up again in Adams and Option SIT 5 years ago. Giving information without comment is not normally advice. Providing information which has been selected as a result of a value judgment can constitute advice. And any element of comparison or evaluation or persuasion is likely to cross the dividing line between information and advice. And in fact, you can actually have advice that doesn't carry any information. So just as you can have information without advice, you can also have advice without information, though usually what the client will be getting is both kinds of thing. So you find yourself in this situation. It is likely to be the case that as a matter of fact, the bank, except in relation to an utterly vanilla transaction, will be found at some point in the process to have given advice. the key questions are going to be whether the bank is under a duty to advise or not. In the case of Mr. and Mrs. Rubenstein, they had gone into the bank and asked a question which was seeking advice. And not only did the bank not say we disclaim any liability for the advice given, the bank also, in one of its internal documents, ticked a box. There's a little tick box. You tick, is this an advised sale or a non-advised sale? And the bank had ticked the box saying it was an advised sale. They tried to persuade the judge at trial that that was a mistake that had been made. You can imagine the response of the judge. You're just like, well, you know, if you said it's advised, that you just got to live with the consequences of that mistake. But generally speaking, one party to a transaction is under no obligation to advise the other about the nature of the transaction, its prudence, or other aspects of it. Now, in general, the courts have been happier to find that banks are under an obligation to advise when we're looking at investments compared to loans. Because investments tend, on the face of it, to create less of an issue of the customer turning around and saying, I don't want to repay this, and that becoming one of the costs that banks then have to factor into the rate at which they lend to people generally. But during the course of the first couple of decades of this century, banks got into the habit of offering customers interest rate swaps. So the customer would take out a variable rate loan and then hedge their liability by entering into an interest rate swap, which might fix the interest. So you've got a loan and an investment product tied up together. And so you had lots of customers arguing that they had been given advice in relation to the swap that they take to fix the loan. Now, some banks, principally Clydesdale and Lloyds, instead of selling the customer two products, the variable rate loan and then the fixed rate loan, the fixed rate swap, would sell the customer one product, which is a fixed rate loan. Now, from the customer's perspective, whether you have two products or one, it's the same amount of money going out each month. If you have a fixed rate loan at 5%, that's the same as having a variable rate loan and then a swap fixing the rate at 5%. So you had customers saying, well, hang on, if there are rules about investments and advice in relation to swaps, we want to use those because we're in exactly the same position. We've just been sold a fixed rate loan. And frankly, we think what these banks are doing is selling us fixed rate loans to get round the statutory rules on advising on investments. Courts weren't interested in that argument at all. In Finch and Lloyd's TSB, his Honour Judge Pelling QC, as he then was, said a bank is not under a duty to advise on onerous loan agreement provisions, and that a duty to advise in relation to a loan could only arise in circumstances which were exceptional and markedly different from the normal relationship between a bank and a borrower. Now you've got, in English law, sort of three ways in which you might try to fix a duty to advise on a bank. One way in which you might try and fix a duty to advise on a bank is through equity. You might say the bank is a fiduciary. The bank owes an obligation to put my interests first. And you can find cases in England up to the 1960s where you had this kind of fiduciary approach being used by the courts. We'll explore in just a minute why that sort of disappears. The second route in is contract. You say as a matter of contract, the bank has undertaken an obligation to advise. What did we see last time we were together? Who writes the contracts between banks and their customers? The banks do. So that's going to create some challenges in finding an express term that the bank owed an obligation to advise. So if you've got option number one is you try and get this through equity, you say the bank's a fiduciary. Option number two is you try and get this through contract, you try and establish some form of contractual term. Option number three, route three, is tort. You say we're going to use the we're going to use tort to say that the bank owed us a duty to advise. There are sort of three different routes that you might use in relation to this. One route is you might use the ordinary common law duty to act with reasonable care and skill. Your second option is to rely on the statutory duty in relation to misrepresentation. We've got that just at the bottom of the page there. Under Section 2.1 of the Misrepresentation Act 1967, if you enter into a contract with someone as a result of a misrepresentation, then you are going to be able to succeed in a claim unless the person making the representation shows that they have reasonable grounds to believe that the facts represented were true. Your third option is to say that actually the bank has told you something that they knew was false, or they were reckless as to whether or not it was true, and so the bank is liable for fraudulent advice. So you've got a number of different routes home. If you were looking for a nice, neat setup in English law where you're able to say there's just one route home when you were given bad advice, you have basically, frankly, almost exactly the opposite. You just have to look at the facts and try and work out which of the different hooks, legally speaking, might result in liability. So, you're doing all of that in this circumstances where on the one hand it's going to be relatively easy for the courts to find that you were given advice, but on the other hand it's going to be relatively difficult to show that you were owed a duty, that the bank owed a duty to advise you because of this overriding policy concern that banks do not owe any duty to advise on the wisdom or viability of commercial projects that they are asked to lend money to fund. And so even if the bank is in possession of information which suggests that the project isn't likely to succeed, it doesn't owe a duty to share that with the customer. So in Hugh, National Commercial Bank Jamaica Limited and Hugh in 2003, Privy Council said, bank cannot be liable for failing to advise a customer if it owes the customer no duty to do so. Generally speaking, banks do not owe their customers to advise them on the wisdom of commercial projects for the purpose of which the bank is asked to lend money. If the bank is to be placed under such a duty, there must be a request from the customer accepted by the bank under which advice is to be given. Privy Council confirmed, lest there be any doubt, a borrower is not entitled to rely on the fact the bank has chosen to lend them money as evidence, still less advice, that the lender thinks the purpose for which the borrower intends to use it will be sound. And I guess the facts of Murphy probably are the most extreme that show this. Mr. and Mrs. Murphy did what lots of people who win the lottery or are successful as recording artists or football players or whatever decide to do in retirement, which is buy a nice property somewhere and run it as a hotel. So Mr. and Mrs. Murphy had no previous experience of running a hotel. They found a property, fell in love with it, decided they were going to buy it. The bank recommended to them which solicitors they should use when buying the property, recommended to them which accountants they should use when buying the property. The bank manager also commissioned a report from a surveyor on the hotel. The surveyor's report, which the bank manager received, said, this property is falling down. This property needs a whole load of work done to it. It's the kind of report that if you got it and you weren't emotionally attached to this property because of its location, would have led you go, right, okay, I'm not buying this one. I'll go and buy a hotel down the road. Go and find something different. Now, the bank has got a copy of this report. Despite having a copy of the report, the bank decided to go ahead and lend the money. It didn't provide a copy of the report to Mr. and Mrs. Murphy. In those circumstances, the judge said there was no fiduciary duty owed, there was no duty of care owed. Settled that the ordinary relationship between a banker and a customer is not a fiduciary relationship. The bank was entitled to decide whether it was prepared to take the risk based on the information in its possession. It did not have to share that information with Mr. and Mrs. Murphy. So let's run through those options. We've crossed off fiduciary's duty for the time being. Let's look then at the next option, which is contract. Well, as we saw last time I was lecturing to you, the contract's likely to be made on the bank's standard terms and conditions. So we need to look at what those terms and conditions mean in themselves. We then need to go on and ask ourselves, are there any implied terms that can be included in the banking contract? Generally speaking, English law is really reluctant to impose implied terms. Will not impose a term simply because it would be reasonable to do so. What you need to show is that it would be necessary for the contract to work to impose the term, or the term is so obvious that it goes without saying. Those tests are unlikely to be satisfied when you are dealing with a contract on a bank's standard terms. What I think you have got to do, if you're trying to create a duty to advise, is to say to the court, well, all right, within the overall context of the relationship between the customer and the bank, there was no duty to advise. But on this specific question, what you have is a separate agreement, what's sometimes called a collateral contract, where the parties make a separate agreement that has separate consideration list and where the terms are different because the bank has assumed a responsibility to advise. Or another way of packaging the same argument is to say, look, how obvious it is that the bank was giving advice, how far the bank went in giving advice, how much the bank knew about the reliance that the customer was placing on the advice. It would be wholly unfair for the bank to be able to point to its written terms and conditions. So the argument here is framed as what is in fact an equitable argument. The argument is that the bank should be stopped from relying on the strict terms of its written contract. Now those are difficult arguments to get home on. They need fairly special facts to use, so they tend not to be the territory where customers trying to get banks under duties to advise go. So we take ourselves then into tort. English law has long imposed liability for fraudulent advice, i.e. advice that is not honestly given. You can't, as a matter of English law, contract out of liability for fraud. the courts always have a sort of, well, save in very, very exceptional circumstances. But then when you look at the case law, you find that they never find that those circumstances exist. The problem with getting a bank on the hook for fraudulent advice is two things. Thing number one. You need to be able to show the state of mind of an individual at the bank was dishonest. So Stanford International Bank and HSBC, they tried to run the argument that HSBC was dishonest. That if you took what person A at HSBC knew and what person B at HSBC knew and what person C at HSBC knew and put it all together, then you could say that the organisation was dishonest. That doesn't work in English law. You have to be able to name an individual and say that individual said something that they knew was false, or they said something and they didn't care whether it was true or false. Now, the ideal situation you want, if you are representing a customer, is you want to be able to point to somebody that was face-to-face with the customer who was in possession of information that they knew was false. You can, however, also get home if you're able to say that one of the managers of that person who was making the statement knew that what was going to be said was false. So I can't, for example, if I know that this class finishes at 3 o'clock, I can't get somebody as my agent to come in and tell you all it's going to carry on to 4 o'clock or 2 o'clock and simply sit there and go, well, because I didn't make the statement personally, I'm not liable. The fact is I authorized somebody else to make a statement that I knew they were going to make, that I knew you were going to rely on, and that I knew was going to be false. So the practical problem with that tends to be simply an evidential one, which is how do you find out who that person is that has that guilty knowledge? And in practical terms, the easiest way to do it, and the way in which these cases most often arise, is you wait for a regulator to make a finding, and then you piggyback off that finding. So we made lots of allegations of fraudulent advice being given when there were regulatory findings that libel was being manipulated. Fraud, if you can get it to work, it's a nuclear weapon, it undoes the contract, damages are at large, it's fantastic. But because it's such a powerful weapon, the courts in England restrain it in terms of the circumstances in which it applies. So it's more frequent to lean on the statutory obligations, statutory obligation in relation to misrepresentation set out in the Misrepresentation Act 1967. This has three big advantages from the point of view of claimants. Number one, there's a reversal of the burden of proof. So once you are able to establish that a representation of fact was made, it is then up to the bank to prove that the maker of the statement had reasonable grounds to believe that the representation was true. Two, those reasonable grounds have to exist both at the time the statement was made and all the way through to the point where the contract is entered into. So you can have a statement that's made during the course of an initial discussion between a customer and a bank with a contract that's signed a number of months later, and the bank bears the risk that somewhere in between when the statement was made and when the contract was entered into, the facts have changed, but they've forgotten to update the customer. And the third thing that makes this cause of action particularly attractive is that in a case called Roy Scott Limited and Rogerson, the Court of Appeal said you get the same damages if you succeed in this cause of action as you do if you succeeded in a claim for fraudulent misrepresentation. So this cause of action, if it is available, seems to give you a lot of the benefits of alleging fraud without having to clear the hurdle of having to allege fraud. So it's a particularly powerful cause of action if it is available. But also available is a common law claim for negligent misstatement. Now, this claim for negligent misstatement comes out of the case of Headley, Byrne and Heller in 1964. These are the facts of that case. A claimant is doing work, advertising work for a customer. And the claimant wants to know whether that customer is going to be able to pay their bill. So the claimant asks her bank, who asks the customer's bank, for a reference. That is, for a verbal description of the solvency of their customer. And the defendant bank replies to the claimant's bank with a reference that says the customer is a respectably constituted company considered good for its ordinary business engagements. In other words, if you're going to engage in a kind of normal, relatively low value contract, you'll be fine. Don't start lending them millions of pounds. That's the message that's communicated. Now, that message has come from the defendant bank to the claimant's bank and then on to the claimant. So there's no direct contractual relationship between the claimant and the defendant bank. Because there's no contract, the claimant has to sue in tort. And so the questions that the court has to grapple with is whether the defendant bank has assumed a duty of care to the claimant, and if so, how extensive. And the way that the court analysed it was in two stages. They said, look, a question was asked of the defendant bank. The defendant bank could have chosen not to answer the question. If it had chosen not to answer the question, the claimant couldn't have had any complaint. But once the defendant bank has decided to answer the question, it has assumed a responsibility for the accuracy of the information it is giving to somebody that it knows is going to rely on that information. But although there was an assumption of responsibility, and although the answer given was inaccurate and therefore negligent, the bank escaped liability. And the bank escaped liability because the reference came with a disclaimer. The disclaimer said, for your own private use and without responsibility on the part of this bank or its official. Now, some of you from a civil law background will look at this result and say, well, in our system, this could all be done within the law of contract. It's just to do with the peculiarities of English law and its requirement for consideration that we end up with this being stuck under tort. And I think there's a lot of merit in that observation. The fact that you are able to control by sending out a document the extent to which you're liable indicates that we're sort of in a kind of almost a contractual world. The tort of negligent misstatement is a device used by English courts in appropriate cases as a device to get round the doctrine of privity of contract. Now, we've got a series of that then work through the implications of this. Playboy Club against Banco Nacional de Lavoro is a fascinating case involving a casino operator. The casino operator wants to know whether one of its customers is somebody it should be extending credit to. The casino operator knows that if it goes and asks the question direct of the bank is not going to answer, because banks do not want to be seen to be encouraging their customers to gamble. So the casino operator uses a third-party intermediary, Burlington, who asks the question. Burlington asks the question. The answer given by the bank is that the customer is trustworthy up to £1.6 million per week. This, by the way, is a reference given in respect of a customer who has an account with the bank but has never put any money into it. So quite how the bank decided that the customer was good for 1.6 million a week is anybody's guess. Well, between the 15th and the 18th of October 2010, the customer played roulette in the casino on a regular basis. In those 4 days, he managed to run up losses of £800,000. When the club attempted to collect that from the bank refused to pay. So the casino operator sued the bank, claiming the bank owed a duty of care in giving the reference. The Supreme Court dismissed the claim. It dismissed the claim on the basis that the casino had chosen to use an intermediary, and that the use of the intermediary meant that the bank had not assumed responsibility to the casino. And that's because, on the facts of that case, the bank did not know who the principal was, for what purposes the reference was being sought. On the other side of the line is Riyadh Bank and Ali United Bank, in which what you had was an investment fund that was being set up. The investment fund needed to be Sharia compliant, and so there was a Sharia advisor. Now that advisor again was giving advice to person A for the benefit of the fund B, but in those circumstances where everybody knew that the advice was being given for the benefit of the fund B, the fact that there was no direct contract because of person A in the way didn't alter the position. And you can work through a series of cases that take us into all sorts of quite nuanced questions about whether or not a bank is going to be held to have assumed responsibility, and whether if a bank is held to have assumed responsibility, that the bank has managed to effectively exclude that obligation. Just to finish up, in relation to negligence, just before we have a break, the standard imposed on a bank when giving advice or giving information is that of reasonable care and skill. Now this means that the bank doesn't have to give the best possible advice, but if what we're looking at is an area of activity where banks are the people who normally give advice in this area, the standard is the standard of the reasonable bank. So this tends to be proved. What you do if you are acting for a claimant in a case like this is you try and find somebody who was a banker specializing in this particular area of activity who has retired in the last couple of years. So their information is still current. They know how what the practices are of banks, and you get them to look at the homework, to look at the information and advice provided and say, not simply I would have done it differently, but in my experience any reasonable bank would have dealt with this, presented this information, provided this advice in a different way. One final thing, the duty to advise is a duty to advise at the time the advice is given. Unless there are exceptional circumstances, a bank does not owe a duty to keep advice under review. That's the case of Fenno-Scandia Limited and Clark. Mr. Clark had received investment advice from a bank. The bank subsequently found out that he was about to be sacked as president, chairman, and chief executive of a company that he ran. He tried to say, the investments you put me in were good investments at the time you gave the advice, but once you realised that my personal circumstances were about to change so dramatically for the worst, you should have come and found me and said, by the way, we need to advise you to cash in your investments because you're going to need the cash. And the court had very little difficulty in saying that unless there's an express agreement to keep advice under review, the duty to advise simply relates to the time that advice needs to be given. Right, we will stop there. Come back in 10 minutes. Do you have a code for the? So then it seems we need. I know a number of people will want that.
I can write it down.
Yeah, please.
How was your week? Busy?
It's fine so far. I'm off to Norway tomorrow for 3 days, so the second half is going to be very busy.
For vacation or for work?
No work. I'm at the University of Oslo.
Because you were head of chamber, so
Yeah.
you're kind of busy.
Yeah, oh yeah. I find enough to keep myself busy. We got the same format as last time, so I've got another hour of talking, and then there's questions. Yeah. Ready to go again? Given the ease with which the courts are likely to find that advice has been given in fact, the major battleground in the courts over the last 20 years has been about the circumstances in which and the extent to which banks can disclaim or opt out of liability for the advice that they give. The case of Mars Limited Bank of Scotland in 2017 is just one of a long series of cases which say that even when a bank is in fact giving advice, the parties are free, which is to say, in practice, the bank is free to exclude that duty by contract. So the bank can, by contract and can, by notices, exclude liability for advice that is in fact given during the course of the sale of an investment or a loan. The key question is, to what extent will the courts limit that ability? And in principle, there are two regimes that potentially limit the bank's ability to exclude liability at common law. There's a separate regime in relation to statutory liability for advice. We're not going to cover that in the course of this lecture. If the customer is a consumer, so if the customer is dealing outside of the course of their trade, business or profession, then the regime that applies is the Consumer Rights Act 2015, which gives effect to and adapts the unfair terms in consumer contracts directives from the EU. If the customer is not a consumer, then we are into the statutory regime on the Unfair Contract Terms Act of 1977, UCTA. Now, the Unfair Contract Terms Act of 1977 does not apply to all contracts generally, or to all contractual clauses generally. It applies to specific kinds of contractual clause. There are two sections that are likely to be of particular importance in the banking context. One is section 2.2. Liability for negligence other than death or personal injury can be excluded so long as the exclusion satisfies the requirement of reasonableness. So, when we're thinking about the liability for failing to act with reasonable care and skill in tort or contract, bank can exclude that liability only if the exclusion satisfies the requirement of reasonableness. Section 3 is also important. When one party deals with another on the other party's standard terms, so the average small business dealing with a bank, or we're dealing with the bank on the bank's standard terms, the party using the standard terms cannot exclude their liability for breach of contract except if such an exclusion satisfies the requirement of reasonableness. And the requirement of reasonableness is something that the court has to assess taking all the circumstances into account. Now that is very useful for a customer facing a claim by the bank, because the customer is able to say, you bank cannot establish the reasonableness of your terms until we've had a trial. So until we've gone through all the expense of instructing lawyers to get all the way through to a trial, you can't succeed against me. The court under section 11 of UCTA has to consider in relation to contractual terms the requirement of reasonableness, looking at whether the term was a fair and reasonable one to be included, having regard to the circumstances which were or ought reasonably to have been known or in the contemplation of the parties when the contract is made. Yes?
Professor, I was just wondering, given ACTA now, other words, with ACTA, considering ACTA now, if Hadley Burn is going to appear before the courts, would it have been decided differently?
Well, you would have had another step in the investigation. So the question that would have been asked was it reasonable for the bank giving the advice to have excluded liability? The answer to that question might have been, on the facts of Headley Burn, yes, because the bank giving the advice wasn't being paid a large amount of money to give the advice. That would be one of the factors that would be taken into account. It's not unreasonable for me if one of my friends says, David, can I please have some legal advice? And I say, well, you can have some legal advice. This is what I think, but I don't accept any responsibility if you choose to act on it. If somebody comes to me and says, I want to pay you £10,000 to give me legal advice, then it becomes a little more difficult for me to say that it's reasonable for me to exclude any liability in relation to that advice that's given. So that might be one factor. Other factors that tend to be taken into account are the ability to get the service from elsewhere, the availability of insurance. There are a whole range of things that could be taken into account in deciding whether or not reasonableness applies. As well as ACTA, applying to terms excluding liability for negligence and excluding liability for breach of contract, Section 3 of the Misrepresentation Act 1967 also subjects terms which exclude or restrict liability for misrepresentation. Those terms are subject to the requirement of reasonableness in Section 11 of ACTA. So it applies to three kinds of term that are there. Now, what we have seen in the case law over the last 20 years is banks saying there is a difference between a situation in which we present a term which says, we know we're going to be giving you advice, but we exclude any liability for the advice that we give you. That, they say, is clearly something that is subject to ACTA. But that is different from a term which says, we are not giving you any advice. So if you come into a meeting with us and we say to you, we are not giving you any advice, that defines the service that we are providing to you as an execution-only service. It defines the service we're giving as a non-advisory service. And because that is the basis on which we are contracting with you, that isn't an exclusion of liability at all. And because it's not an exclusion of liability at all, it means no matter how unreasonable that statement is, no matter how contradictory that statement is to the facts of what actually happens, you, the customer, cannot complain if we gave you advice and you relied on it and it turned out to be a disaster. And there's been a long series of cases establishing that proposition, which is sometimes described as contractual estoppel. In JP Morgan, Chase Bank and Springwell Navigation Corporation, Springwell was a company used by a wealthy Greek family with shipping interests for their investments. They'd invested in complex debt instruments linked to bonds issued by Russia. When Russia defaulted on its financial obligations, the portfolio collapsed in value. And they said, you advised us to invest in these Russian bonds. That's the cause of our losses. Court of Appeal held that the bank did not owe a duty of care in contract or tort to advise Springwell as to its appropriate investments. That the people running Springwell were experienced and sophisticated business people who had been dealing with the bank for many years without an advisory relationship. Even though they had been given advice by a salesman, that was not the result of a duty to advise. Nothing in the contractual documentation gave rise to an obligation to advise as to appropriate investments. Nothing in the banking relationship could be said to give rise to it impliedly. So all the advice given in fact did not alter the fact that the basis of their relationship was a trading, execution only relationship. Now, on the facts of that case, with very sophisticated business people who could have gone to the bank and said, we want to change the terms of our contract with you so that you have to give us advice, and would have been able to pay for the advice if that was the service they wanted, you can understand why the court ended up where it did. That case was then followed in PK Intermark Limited and Australia and New Zealand Banking Group. And in that case, sorry, it wasn't, that case was a little earlier. In that case, again, we're dealing with bonds issued by the Russian Treasury. The Court of Appeal said, actually, the explanation was plain on the face of the documents. What should have happened was that the person relying on what he'd been told was somebody who should have looked at the documents. If he'd looked at the documents and read the documents, then he would have realised the true position. His decision not to read the documents was his own choice. He's taken the risk that the documents turn out to be contradictory from what he's been told. Again, high value, sophisticated customer with advice from other sources available to them. You can see why the court might head in that direction on the facts. What then happened was the case of Crestsign. You remember before the break I told you about the practice of banks selling customers an interest rate, a variable interest loan, and then hedging that loan with a fixed rate swap. Crestsign is one of those cases. It's a small business where the bank salesman advises the company to enter into one of two swaps that have been selected by the salesperson. So if we go right back to the beginning of our lecture with the pre-judgment, the selection of something, the salesman's come along and said, these are the two things I recommend to you. The judge found that there was a disparity in knowledge and expertise between the directors of the company on the one hand and the salesperson at the other, at the bank at the other, such that both sides would have expected the customer to rely on the advice given by the salesperson at the bank. The judge went on to say, not only is the salesperson given advice, but the advice the salesperson is given is negligent. But, said the judge, the bank is not liable for the negligent advice because it could rely on the clauses in its standard terms and conditions, even though those clauses were sent to the small business after the meeting at which the advice was given. Because they were sent before the contract was entered into in which the customer relied on the advice, that gave the bank an out. What is more, the judge said the clauses that I'm looking at are basis clauses, which are therefore not subject to the requirement of reasonableness under the Unfair Contract Terms Act. They're not exclusion clauses, which would be. The judge said the difference between a basis clause and an exclusion clause was whether, understood in their proper context from the perspective of an impartial and reasonable observer, they prevent a representation being made, or whether by contrast they exclude liability for making it. And then the judge, who was a very new judge at that stage, went on and made a fatal move. The judge went on to say, these are basis clauses, they're not subject to the requirement of reasonableness, so the bank wins. However, if I had found that they were exclusion clauses, I would have gone on to find that the requirement of reasonableness was not satisfied. That actually, if I was allowed to apply the test to see whether these were reasonable standard clauses to include, I would have found that these clauses were not reasonable. If you were the small business and you faced that judgment at first instance, what would you do? Appeal. You'd appeal. So the small business appeals. They appeal. If you were the bank and you were facing an appeal against that decision, what would you do? You'd settle it. Yes, the small business was paid every penny piece of the claim that it was making by the bank in order to settle the appeal, in order to hang on to the benefit of that judgment at first instance and not get it overturned in the Court of Appeal. So this is one of those instances where you get the English doctrine of precedent and you say, well, this is what the textbook says the law is, but the value of that as a case is one that we need to interrogate. Now, having said that, there was then a series of cases following Crescine in which the courts said on a number of occasions, no, there is this distinction between basis clauses and exclusion clauses. Thornbridge and Barclays Bank is one of them. Property Alliance Group and RBS in 2018 is another. Mars Limited and Bank of Scotland, which I've mentioned previously, is another one. So we have these series of cases in which other first instance decisions have lined up and reinforced what the judge said in Crescine. The outlier, the only time the Court of Appeal has had to consider it, is First Tower Trustees and CDS Superstores Limited. What they said is this: it is now firmly established that parties can bind themselves by contract to accept a particular state of affairs, even if they know that state of affairs to be untrue. This is a particular form of estoppel which has been given the name contractual estoppel. Unlike most forms of estoppel, it requires no proof of reliance other than the entry into the contract itself. Thus, as a matter of contract, parties can bind themselves at common law to a fictional state of affairs in which no representations have been or made, or if they have been made, have not been relied on. But the Court of Appeal said, we are going to be astute to ask whether a clause is in fact a basis clause or is an exclusion clause. The illustration Lord Justice Leveson used was, think about a decorator. And you ask your decorator to paint your house. If the decorator paints your house and paints your house badly, you've got a claim against the decorator and an exclusion of liability for painting your house. Well, that is something that's going to be subject to the requirement of reasonableness. But what if the decorator agrees to paint your house but not the garage doors? Well, in those circumstances, you cannot complain that the decorator didn't paint the garage doors because that's not the service you contracted for. That analogy is sort of helpful, but it doesn't solve all the problems in working out the difference between a basis clause and an exclusion clause. There's also one other section of UCTA that hasn't been tested, and that is Section 13 of the Unfair Contract Terms Act. And Section 13 of the Unfair Contract Terms Act says this Act applies to all varieties of exemption and exclusion clause. So from the point of view of somebody advising a customer, what you want to say is there comes a point at which what is written down on paper on behalf of the bank is so wholly different from what has happened in practice that either as a matter of estoppel, the bank is stopped from relying on its own contract, or what it's doing is it's using its contract to exclude liability that would otherwise exist. The way that it was put in Raiffeisen Zentralbank and RBS by Christopher Clark was the court should not apply a clause which attempts to rewrite history or part company with reality. The distinction made in that case was between sophisticated commercial parties who agree in terms of which they're both aware to regulate their future relationship by prescribing the basis on which they're dealing with one another. And where you tell a man, that's the one hand. On the other hand, you tell a man in the street that your car you're selling him is perfect, and then agree that no representations have been made or may be relied on. That's nothing more than an attempt retrospectively to alter the character and the effect of what has gone on before, and is in substance an attempt to exclude or restrict liability. Where we are in relation to all of this is in a mess. And we've been waiting for the right set of facts with the right funded claimant to test out and explore some of the many permutations of this. I'm going to talk for another half hour or so, then we'll have a break, and then we've got, as we had last time, some questions to work through, which will highlight some of the factual challenges that can exist in this area. I mentioned previously, one of the reasons why the courts are concerned in this area is that they don't want banks to find themselves in a position where every time a bank tries to enforce a loan against the customer raises a "you gave me advice" defense. And so, as well as restricting the circumstances in which these defenses these arguments can be raised by customers, the courts also give effect to no set-off clauses. So a no set-off clause is a clause that a bank can use that basically says, pay up first and argue later. So the bank says you cannot use the suggestion that I gave you advice as a reason for not paying the loan in the first instance. What you need to do is pay up first, and then if you want to sue me for giving bad advice, then you can do that. And those kinds of clauses are often a very effective way for lenders of closing down spurious arguments by customers who say they were given advice. In AMC 3 Purple BV against Amethyst Radiotherapy, the courts approved the use of such set-off clauses or no set-off clauses in appropriate cases, but pointed out that they are subject to the rules in UCTA if we are dealing with if we're dealing with a loan to a business, and they're subject to the rules set out in the Consumer Rights Act if we are dealing with a consumer. I've included in the handout for you the rules in relation to consumers and the statutory clauses that exist there. The test for fairness is in section 62(4). A term is unfair if, contrary to the requirement of good faith, it causes a significant imbalance in the parties' rights and obligations under the contract to the detriment of the consumer. What happened to that clause in the hands of the judiciary is a travesty. So English law is notorious in that its law of contract does not include the idea of good faith as a central idea in the English law of contract. This provision in section 62.4 comes from the Unfair Terms and Consumer Contracts Directive, a piece of EU law. The EU contains a lot of civil jurisdictions which do have the idea of good faith in their law of contract. It's there in the German law of contract, it's there in the French law of contract, just to take two examples. So you might have thought that when the English courts were coming across this requirement of good faith in a piece of EU law, they would have said to themselves, I wonder how this concept applies in other jurisdictions in the EU. Let's have a look to inform our interpretation of this. Or, since this came up for consideration whilst the UK was still part of the EU, why the English court didn't say, I know what we'll do, we'll ask the European Court of Justice what the answer to the question is. What does this mean? They didn't do either of those things. In a couple of cases, the first of which was Director General of Fair Trading and First National Bank, and the second of which was Office of Fair Trading against Abbey National, the English Supreme Court decided that it could interpret what was meant by the requirement of good faith. In Director General of Fair Trading against First National Bank, the House of Lords decided that good faith simply meant nothing more than not taking advantage of the other party. And in the second case, Office of Fair Trading against Abbey National, the UK's highest court decided that overdraft charges couldn't have their fairness assessed at all, because the one thing that's excluded in relation to the requirement of fairness is anything in relation to the price. And even though overdraft charges on current accounts were only payable by customers if they weren't overdrawn, so they weren't paid by every customer as part of the service, the Supreme Court, highest court, still held that they couldn't be considered. So on the two occasions that these regulations, the regulations that are now translated into the Consumer Rights Act, got to the highest court in England, the consumers' rights were read down rather than being read up. So I don't know how you're feeling at this stage about the prospects of holding banks liable for giving bad advice. It can be challenging, but there are some examples to the contrary. Verity and Spindler, 1996. The claimants were a couple. He was an acupuncturist. She was a teacher and masseuse. They decided to invest in property. They went to the bank and received encouragement from the bank manager that property investment would be a good idea. This is what the judge said about the bank manager. He went to visit properties with them, he discussed matters with them, and he generally behaved like an uncle. The bank's advertising declared, together you and your manager can decide what is best for your business. Don't hesitate to ask your manager for advice. We don't only help with money. Our advice is tailor-made, confidential and free. It is frank, professional and yours for the asking. Guess what the bank tried to run when they brought a claim saying they'd been given bad advice? It tried to run an argument that it didn't owe them a duty to advise, that it had disclaimed any responsibility for advising. The judge said, well, given your advertising, you can't run that argument. You are clearly holding yourself out as prepared to give advice. Key to the judge's decision in that case were the findings that, one, they had asked for advice. Two, the manager had given advice, and not just kind of ad hoc advice, but had assumed an advisory role. So this might be helpful to us in thinking about where do we draw the line. The person who is basically a salesman who accidentally gives advice You can see why you might want to say, well, okay, the bank is entitled to say, not reasonable for you to rely on that for whatever reason. But here we have a sort of thorough shift from sales mode into advice mode. That's now become the kind of basis of the relationship. And thirdly, this disparity between the lack of sophistication of the customer, described by the judges as very naive and inexperienced in money matters, and therefore the reasonableness for the manager giving the advice to understand that the advice that they are giving is going to be relied on. With me so far? Great. Okay. We started this lecture by saying there's information on the one hand and there's advice on the other. And that binary between information and advice had been really important, because if you were saying, I went into a transaction and it was a bad transaction for me, if you were able to establish that you entered in the transaction as a result of bad advice, the normal remedy was to put you in the position you would have been in if you hadn't entered into the transaction at all. Whereas if you were saying I was given bad information, the normal remedy would be to put you in the position you would have been in if you'd entered into the same transaction but had been given accurate information. So from the point of view of the claimants, the damages are much larger or potentially much larger in most cases in the bad advice case than in the bad information case. There was, however, a case called Cornish and Midland Bank in 1985 in which Lord Justice Glidewell said, once a bank starts giving an explanation to its customers, it is obliged to explain fully and properly the nature of the borrowing that the customer is about to undertake. So a bank can choose to say nothing, but if it decides to say something, it's not just about not saying something inaccurate. There's actually potentially a positive obligation to give an adequate explanation. So in particular, if you start explaining the benefits of a transaction, you also have to explain the risks. And on the facts of that case, the bank had been found liable when an employee of the bank had told the claimants that the mortgage was just the same as the building society mortgage, when in fact it contained more onerous provisions. Now, that duty was by and large forgotten about by practicing lawyers. It featured occasionally in the textbooks. Where it was mentioned in the textbooks, it was presented as an example of a duty to advise. But actually, it's one of those things where if you read the case, you could see that it actually potentially applied in cases where there wasn't a duty to advise. And this is something that I picked up on in lectures I was giving in universities and in lectures I was giving to other lawyers. And one lawyer who came across that argument was the lawyer who acted for the customer in Cressign. And therefore, in that case, he ran the argument that there was this duty to explain, described as a mezzanine duty. So if you've got the ground floor of information and you've got the top floor of the duty to advise, this duty to explain sort of sits in the middle. And the judge thought, in that case, Cressign, that although there's no duty to provide information, any information provided should not be misleading, and if the bank chooses to explain the nature and effect of a product, then it must tender a full, accurate, and proper explanation. Well, we went on into Thornbridge and Property Alliance groups. The court said, well, we don't like this idea of a mezzanine duty. But you could see that this binary between advice and information was beginning to break down as the courts began to realize that in the real world, things are much more blurry. Not just black or white, but maybe 50 shades of grey in between. And the first time we see this is in the Supreme Court in 2017 in Hughes Holland and BPE solicitors, in which the Supreme Court says advice and information are not distinct or mutually exclusive categories. That the question should be focus on what has the bank assumed responsibility for? And that could be a sliding scale between the person who just assumes responsibility for the facts that they're giving you or the opinion that they're expressing. Think the property valuer. Property valuer comes along and says, this property is worth £500,000. Now, if the property at the time the valuer values it is in fact worth £300,000, well, what are they liable for? The difference between the 500,000 they said it was worth and the 300,000 it was in fact worth, 200,000. The fact that the property market then subsequently crashes so that the property is now worth 100,000, well, that's irrelevant because that's not something they assumed responsibility for. They weren't making a forecast about what was going to happen in the property market. What they were doing is saying what the value of this property was on this particular day. So that's at one end of the scale. The other end of the scale, they say, is the investment advisor who says, you don't need to worry about any decisions about how to use your money. My recommendation to you is this. There, the investment manager advisor is taking control of the entire transaction and is responsible for everything. And so we have this kind of range of, or spectrum, and we have to work out where we are on the spectrum. And for people like me advising clients, this focus on what is it in particular that has been assumed has become absolutely key because of a Supreme Court decision 5 years ago, Manchester Building Society and Grant Thornton. Now, Manchester Building Society and Grant Thornton is concerned with a case in which a building society asked its accountants about some long-term hedging products that it was thinking about investing in. Millions and millions of pounds worth is at stake. And what the court said there is there are 6 questions you need to ask yourself in a case where you're alleging negligence in relation to something that was said. The first one is the harm that's the subject matter of the claim actionable in negligence? That's nice and easy. The answer in most financial services claims is going to be yes. Second question is, what's the scope of the duty? What are the risks of harm to the claimant against which the law imposes on the defendant a duty to take care? So the example that is given is this. I go to see the doctor and I say to the doctor, am I fit enough to go skiing? And the doctor says, yes, you're fit enough to go skiing. Now, if the doctor had done their job properly, the doctor would have spotted I have a knee injury, which means it's not safe for me to go skiing. I go skiing. Whilst I'm skiing, I suffer an accident. I suffer an accident because I'm a terrible skier and I haven't been skiing since I was at university. And I still think I'm in my 20s and I take on a run that I shouldn't be taking on and I suffer an injury. It's an injury that I would have suffered even if I had 2 fit knees. So the question is the doctor liable? Now, if you just take a but-for test, you say, if the doctor had given me the correct advice, I would never have been on the ski slopes in the first place, therefore I would never have suffered the injury that I suffered. But instinctively, we think, well, hang on a minute, if you'd have suffered the injury anyway, the risk of you crashing because you're a terrible skier is not the risk the doctor was being asked to prevent. Now, that example is nice and easy to work out. The thing that keeps me busy and employed are all the more difficult circumstances where that's much harder to apply. So your first question, is it actionable? Second question, what's the scope of the duty? What risks are being advised against? What are the risks of harm against which the defendant owes a duty to take care? Third question is then, is that breached? Has that duty been breached? Fourth question is the factual causation question. Is the loss the consequence of the act or omission? And then at the fifth stage, we're back again to the same kind of question that we had at the second stage. The duty nexus question. Is there a sufficient nexus between a particular element of harm for which the claimant seeks damages and the subject matter of the defendant's duty of care? So this enables the courts to make policy judgments about whether they think it would be just or not to impose on a defendant liability for particular consequences. So, to take an example, I'm a company, I have a bank account, I have one of the employees of the company is a signatory on that bank account. They have been stealing money from the account. The bank, if it had exercised reasonable care and skill, should have spotted that they were stealing money. Is the bank liable for the failure of my business, or only liable for the not stopping the particular transactions that were theft? The answer the courts say is the risk that the bank was owing a duty to protect was the risk of theft. It wasn't the risk of the theft causing the collapse of your business or your business not being strong enough to survive the theft. So you're using this tool to restrict the damages to ones that fit the wrong that has occurred. And then you get into all the sort of, the sixth question is all the sort of standard things that exist in the law of tort, which are other ways in which English courts restrict damages, thinking about remoteness, different effective causes, failure to mitigate, and so on. So where we are now is where I started with advice on the one hand and information on the other hand. We're now blurring those, and we're saying in each case what you've got to do is say to yourself, what is it that the bank has said? What responsibility did the bank owe for what it had said? And then what loss has been caused by that, applying these multiple tests in terms of thinking about how we assess that level of loss. Well, I started at the beginning of the lecture by saying there are three basic families of remedy or routes home. We could try contract, we could try tort, we could try equity. I dismissed equity at the beginning. Let me just return to equity very briefly. In order to get home in a claim for equity, you need to be able to point to fiduciary duty. And English law is saying two things about fiduciary duties. Most recently, in the case last year in the Supreme Court, there are established categories of fiduciary duties. Trustees owe fiduciary duties, directors owe fiduciary duties, agents owe fiduciary duties. But outside of those, you're not going to have a fiduciary duty if both parties know that one party is acting as an arm's length seller and pursuing its own commercial interests in so doing, and without having given any undertaking of single-minded loyalty to its customers. So lots of circumstances in which you're not going to be able to establish fiduciary duty. Where there is a fiduciary duty that exists, it is now shaped by contract. So if you are fortunate enough to have a bank that is happy to act as your investment manager and investment advisor because you have so many millions or billions for them to invest, their liability will be fiduciary in nature, but they can shape it by the contract so that it allows themselves to pay themselves fees and so on for managing your investments. It will all be in there. The direction of travel in these couple of recent cases I've just put in here that English courts are definitely going for is the courts are really strict on fiduciaries. Where fiduciaries duties are established, any undisclosed profit is going to be confiscated by the courts and paid over to the person to whom the duty is owed, even if that is a profit which the person to whom the duty is owed could not have got it. So if you're found liable as a fiduciary, the courts will throw the book at you. On the other hand, the courts restrict the circumstances in which you are found to be a fiduciary. So that means we find it very unusual to find a case where there is a breach of fiduciary duty against a bank. The last one that we really find is Woods against Martin's Bank in 1959. What happened in that case was that the customer, who didn't have any real business experience, went to see the bank and said, "Can you help me? I've got money, I don't know what to do with it." And the bank manager said, "Well, we'd be only too pleased to look after your financial affairs." The bank manager advised the customer to invest in a company that had a very large overdraft. So the investment that the bank advised the customer to make was one that directly benefited the bank because the bank saw this overdraft, large overdraft, paid off. The company in which the investment was made failed, and the bank gets sued by the customer. The customer sued the bank saying, "You gave fraudulent advice," but the judge held that the bank manager had honestly believed the advice that they gave. However, it's one of those things where I think the judge went, if I find fraud, I destroy the bank manager's career. What I can do is I can avoid finding fraud, but I can still fine for the customer by finding that on these facts, the bank had assumed a duty to advise the customer and that there was a fiduciary duty between the customer and the bank. And that fiduciary duty had been breached because the manager should never have advised the customer without making full disclosure of the conflict of interests, and the advice given had not been given with reasonable skill and care. Probably the most important thing to say about that decision is look at the date of it. That is 1959. And if we go back up the page to look at when Hedley, Byrne and Heller came in, we'll eventually find that Hedley, Byrne and Heller came in 1964. So I think what we have there is the court had to reach for fiduciary duties in 1959 because there was no duty of negligent misstatement. I think that case would probably have been decided differently if it was being decided in the era of negligent misstatement. With that, we'll take another break. When we come back, we will be dealing with some problem questions. Yeah. Yes, we do. Okay, so I don't record this hour. However, Marcel normally produces a model answer at the end of it, so you get the model answer circulated.
It will be on
QM Plus. Yeah. Of course. Ready to go? Okay, so first question. Mr. Loaded is the customer of Cautious Bank. He's being approached by Miss Dubious. What does Miss Dubious need to be aware of? Yeah.
First of all, he has to be conscious that he cannot enter in a conflict of interest by suggesting to the customer to invest into broke company to reimburse the overdraft.
So jumping ahead to part 3, there's a conflict of interest between the bank on the one hand and the customer in relation to broke code. Does that conflict of interest mean that the bank can never advise Mr. Loaded to make an investment in broke code? No. So what would the bank need to do then?
The bank would need to open up the conflict of interest. They have, considering the situation with broker.
What would they have to do in order to be open about that conflict of interest?
I think they need to disclose the status of things.
So disclose what status?
That there's an overdraft.
Okay. Can any of you think of any issues that there might be with the bank disclosing to Mr. Loaded the status of another customer's account? Yes. Private information, yeah. So it's confidential information. Does that mean that the bank cannot disclose that information to Mr. Loaded? I've got some yeses, I've got some no's. How many saying no? What's the reasoning? Yeah, so if you've got a duty of confidentiality that is owed to BrokerCo, one of the exceptions to confidentiality is disclosure with the customer's consent. That's a useful pen. So if the bank goes to BrokerCo and says, we found a potential investor, will you consent to us disclosing the state of your overdraft? What's BrokerCo likely to say? Well, it might say no. It depends how much they want the investment. If they really want the investment, BrokerCo may well say yes. So there is a path through in relation to this, but it starts with talking to Broco. Broco say we're not interested in this investment, then that's the end of it. Broco say yes, we would be interested. Then you've got customer consent. With the benefit of the customer consent, then the bank is able to go to Mr. Loaded and say, right, here we go, full disclosure, this is our position. I can't advise you, I think if I was doing it, I can't advise you whether or not to invest because of the conflict of interest that exists. What I can tell you is, this is Broco's situation, this is how much it owes. If you want to go off and do your own due diligence, go off and do your own due diligence. That's the safest course of action, I think, for the bank to take in these circumstances. So that's number 3. Where do we start? If we go back up to earlier in the question. What is the relationship between Mr. Loaded and Cautious Bank? So the banker-customer relationship. Does that banker-customer relationship include an obligation on the bank to advise as part of the standard features of that relationship? No, it doesn't. But what has Mr. Loaded come and done?
He has stretched the relationship further to now, in the event that the bank advises, it now becomes a fiduciary relationship.
So he's made a request for advice. Now the bank has a choice how it responds to that request. If the bank says no, we're not giving you any advice, then we don't get a fiduciary relationship, we don't get an advisory relationship. But if the bank does respond to that by deciding to give advice, what would you advise the bank to do? Yes?
Maybe they would say like a disclaimer.
Put in a disclaimer. How would the courts assess that disclaimer? So the court will want to know whether or not this is binding. Given the nature of Mr. Loaded as a customer, which set of tests is going to apply? Well, if Mr. Loaded was a professional, if Mr. Loaded was a business customer, then we would be in the realms as a requirement of reasonableness under the Unfair Contract Terms Act. If Mr. Loaded is simply a wealthy consumer, no. If Mr. Loaded is simply a wealthy consumer, we're going to be applying the Consumer Rights Act. So you need to have a think through that in terms of how you word your disclaimer. So if you're going to word your disclaimer, are you going to word your disclaimer as we're giving you advice but we're not liable for any consequence of the advice? Or are you going to word your disclaimer and say, this advice is being given free of charge, it's not part of our contract with you?
I think you're asking us, right?
Yeah.
I think the first one, because if you're saying we're giving you the advice free of charge, whether the advice is given free of charge does not deny liability.
That is true. So what if you put on there then this advice is given without any acceptance of responsibility?
That would make more sense.
Okay. Now that is still, in the case of a consumer, that is still going to run into a question about whether or not that is something that is fair, having regard to the requirement of good faith. So, we've got 3 possibilities as to where the money might go. We've got BrokeCo, which we've explored, that's number 3. We've got the deposit account, and we've got the bond linked to the stock market. Any issues in recommending the deposit account? Yeah.
It might not be the better return on investment as it can be the bond, which is indexed on the stock market. But the issue is that he has to be aware that the advice is giving has to be reasonable at the time it is being given. And for example, if like 5 years later the market collapsed and the customer is now complaining, no, he cannot basically sue the bank because at that time the advice was being reasonable because for example, imagine the market was performing well and 5 years later it is not. So
okay. So what are the advantages of the deposit account? It's safe. Sorry. It might be instant liquidity. It might be that the deposit account requires a period of notice. You can have deposit accounts that require 1 month's notice, or 3 months' notice, or a year's notice. So you have those features. What are the disadvantages? Yeah, might not provide the best return. So how do we work out, if we're the advisor at the bank, what is the best option for Mr. Loaded? One of the things you need to know is his risk tolerance. Another thing you need to know is what period of time he's planning on investing. Is this money he needs next week? Or is this money he's putting away for 5 years' time because he's got some family thing, whether it's paying for children's education or weddings or some grand holiday he's planning where he's got a longer horizon. You need to understand the client's risk tolerance and the client's objectives before you can know what kind of investment is best. And I think one of the dangers that bank managers and financial advisors generally run into is that they start trying to give customers advice about what would be best without understanding the client's circumstances. What are the disadvantages in relation to the bond linked to the stock market that the bank manager might need to warn about? Yes, and what's one of the consequences of that?
Reduction in maybe the projected interest.
Flip it to the other side of the scenario. The big difference between a deposit and an investment is that with a deposit, if everything goes wrong, you get the sum of money you put in back from the bank. With an investment, the minute you move out of a deposit account into another asset class, you run the risk that you do not get back the sum that you've put in if the market performs badly. And so that would be the risk that would need to be warned about. And which case that we've looked at do the facts of that first example seem very similar to? The last one we did, yeah, Woods and Martin's Bank. The facts are very similar, but it's just to help you see how that case might be approached if that factual scenario came up in 2026 instead of in 1959. Anybody who wanted to write that down, written it down? We'll then move on to the next one.
I do have a question.
Yes.
In view of, or my understanding of the general principle of disclosure is that you are not necessarily under an obligation to disclose unless you're like asked to disclose or asked a particular question. But what does the role of let's say he was an investment banker, but was approaching his bank to give him investment advice, would our answers be different?
So, what you are being given in this lecture is half of the picture. The other half of the picture, I think I'm coming back to talk to you about in a couple of weeks' time. So, where disclosure obligations are placed on banks by the FCA, they are to be found in the COBS handbook, the Conduct of Business Sourcebook. The Conduct of Business Sourcebook divides clients into three categories: eligible counterparties, professional clients, and retail clients. And broadly speaking, eligible counterparties don't need advice because they know everything themselves. They're the ones who give advice on the markets. Professional clients can afford to pay for advice separately. Retail clients, probably their only source of information about financial products and services will be coming from the bank selling it to them. And so the statute says we will impose a duty, or the regulator says we'll impose a duty of disclosure on banks in relation to retail clients. We'll have a much lower threshold for disclosure in relation to professional clients, no obligations of disclosure in relation to eligible counterparties. So that's where it comes in practice. And if I were, if somebody would come in to me and asking me a question in the course of my legal practice, I would be going through the common law and I'd be going through the statutory. And in fact, because of all the issues of the common law that we've been looking at today, I'd probably start my advice by looking at the statutory position. Yeah. Okay, so Mr. Lazy Larry, the salesman at Careless Bank. What's happened here? What has Mary asked for? She's asked for a fixed rate loan. What has Lazy Larry done?
He's made an offer of something that would be better to her.
He's offered something that appears to be better for her. Is it better for her, in fact? No. Is that a problem? If we were just dealing with those facts in that first paragraph on its own, has Mary got a claim? Sorry?
For now, I don't think so.
So Marcel doesn't think so. Anybody disagree with that? Anybody think Mary might? Yes?
I think there is misrepresentation.
Okay, talk to me how you phrase that misrepresentation.
As in his position, he's supposed to inform the client of the risks that are involved with investment, even if there's an issue in interest rate or any deviation in that curve. So he's withholding that information.
Okay, so what you might say is you might say that in presenting her with, in answering her request, by offering her an alternative product, he is representing that that alternative product is either the same as the product she's asking for, or is in all respects better for her than the product she's asking for. Since that is what she is going to assume he is saying when he puts forward the alternative, failing to say, well, it's got these advantages for you, but it's also got these disadvantages, is only giving her half the picture. So that would be how you might present it. So English law does not impose a duty to speak. You can keep completely quiet, but once you open your mouth, English law is concerned about half-truths. And so it can be a misrepresentation if a statement of fact is only half-truth. Did you have a comment to make?
Yeah, I was thinking of Hadley Burn.
Yeah.
Because
Yeah.
So I would say that this is misrepresentation, and primarily because he does recommend a different product.
Okay.
Yeah. And that can essentially be an assumption.
Okay, so on the face of it, if we're looking at it, she's gone in and said, I want to buy product A. He said, actually, you don't really want to buy product A. I would recommend you buy product B. So if you're just at that stage of things, you would say that there might be an assumption of responsibility. Now, you might want to frame it in a kind of Hedley Byrne style way, because a distinction that's sometimes drawn between misstatements and misrepresentation is that misrepresentations have to be about present facts. So she would want to say, if you're advising the customer, as a matter of present fact, if you look at the terms on which break costs are calculated for the swap compared with the fixed rate loan, they're different. That is a present fact. It's a present difference between the two. So that's a misrepresentation. If you're the bank, you might want to say, well, actually, the break costs, in fact, were the same at this time. It was just that in future they'd be different, and that's a promise about the future, and so it doesn't get caught by misrepresentation. I think I'd probably be with her on that argument. So let's move on to the next paragraph, then.
Sorry, Professor.
Yeah.
Quick question. In your notes, you actually cited the case of Cornish and Midland Bank.
Yes.
Where Lord Justice Bidwell say that once a bank enters upon the task of advising customer, it's obliged to explain fully and properly.
Yes.
I was wondering whether the case is actually on forewarned.
Well, I think the question now is, to what extent Cornish is still good law? Because in Cressine it was picked up on as this kind of duty halfway between an advisory duty and an information duty. In subsequent cases they've said, well, it's not that, there's this spectrum that we've got to think about. So, yeah, you might point to that still. It's still a Court of Appeal case, it still hasn't been overturned in the House, in the Supreme Court, so it's still open to run that argument. It's just not something the courts have been keen on picking up on. Now, after the meeting, Larry sends Mary a copy of his presentation. The presentation says Careless Bank is not acting as her financial advisor. The small print on the presentation says that the swap is being entered into on Careless Bank's standard terms and conditions, which are available on its website. The standard terms and conditions warrant that she is not relying on any representations made by any salesman at Careless Bank. So what have we got there? Sorry?
But basically, they are like excluding any advice given.
So we've got a basis clause here. They're saying we haven't advised you. What are we feeling about that basis clause? Yes. Well, what do you think?
Yeah, because it wasn't expressly stated in me. But I mean, it doesn't take away from the fact that he can give like the negatives to it. He just doesn't, and it wasn't said.
So if you were trying to package the argument that he didn't point out the negatives and that this was only said afterwards, how would you package it? What would you say he is attempting to do now?
It's attempting to basically not have liability.
He is, and what is he doing? What you would say if you were for Mary, you would say what the bank is attempting to do here is to rewrite history. The fact is, a meeting happened. At that meeting, he gave advice. He knew he was giving advice. He knew she was relying on the advice. And now the bank's trying to turn around and say after the event, oh, actually, do you know what? We weren't acting as your advisor. Now, here's the question. The question is, if you are the courts, and the sequence is, meeting at which advice is given, documentation sent out, then contract, does the documentation sent out still catch Mary and stop Mary from having a claim because the documentation was sent out pre-contract.
I think it came after the fact. The only thing that would save the bank in this instance, I think in line with the case that you gave, is if they had like an express outfit indicating that they would never in any capacity at all act as an advisor to a client. But if that's not the case, I'm just saying as an exception, but if that's not the case, it still won't catch Mary.
Why is Mary bound by that policy if she has no idea that that policy exists?
So no, I'm saying she's not bound by the policy. That's what I'm saying. That
Right.
she wouldn't be prevented from making a claim, except the bank has like a public notice or it's public knowledge.
Right. Well, the facts you're asked to assume here is that she doesn't know that the bank has that. The bank simply, after the event, but before the contract, has sent out the documentation saying it wasn't acting as her advisor.
Then it means that Mary has a claim against the bank. That's my position.
Okay. Yes.
If we rely on the misrepresentation argument, which is the fact that she wasn't presented with the full truth, then is the second half almost like irrelevant to a point? Because if you're saying that the issue was that she didn't give me information, whereas if you disregard that, then I guess you can say that she didn't cite. She had, the disclosure took place before she signed the contract, so the bank wouldn't be liable in that case. But if we're looking at the misrepresentation perspective, then I don't really know how they would tie together.
Okay. So I think there are two different things going on here. Let's move on to the second one you're asking about. If I was acting for Mary and I was running your argument of misrepresentation, I would say she entered into that contract as a result of advice that was given. The notice that was sent to her afterwards was not enough to stop her relying on that advice and to stop it being reasonable for her to rely on that advice. Or to put it another way, the bank, when it sent out the standard notice, knew that the standard notice was inaccurate and knew that she would not think that she was bound by it. And therefore, I would say that this is an attempt to exclude liability from misrepresentation. That is subject to the requirement of reasonableness under the Unfair Contract Terms Act, and to send the documentation out in those circumstances after the event is not reasonable. That would be how I would run things if I was for Mary. Let's go back to the first point though. The first point is the timing point. So the approach that the courts have tended to take is that so long as the bank has sent out its documentation before the contract is entered into, then the customer is on notice of what the terms of the contract is going to be and is therefore bound by the terms of the contract. But we have not had a case that has gone to trial where the focus has been on the facts in the way that they are here. Because it seems to me that the court ought to take account of basic psychology. I think basic psychology runs like this. If I say to you, we're going to have a meeting tomorrow. At that meeting, I'm going to talk to you about a whole series of financial products. I should warn you that anything I say to you in that meeting, you are not entitled to rely on as advice. Because I'm not your financial advisor. I'm just going to be giving you information about the products. And then the next day we have a meeting. You know, when you go into that meeting, what the basis of that meeting is. I'm not your financial advisor. I told you that in advance of the meeting. and therefore you can apply, you can be on your guard and apply whatever filters you think are appropriate to apply when listening to what I say, when you make up your mind about what you know is your decision about what product to choose. That makes perfect psychological sense. To suggest that somebody who has had a meeting at which they feel like they've been given a whole load of advice should, as a result of an email received a week later, open that email, read an attachment, spot that somewhere in the small print it says, by the way, you know that meeting we had last week where you were given a whole load of advice? You should forget that was advice. It wasn't advice. You need to remember that it's your decision. The bank wasn't giving you any. That's just not how people work. It's not how the reasonable person would operate. The reasonable person would find it very psychologically difficult to adjust. Now at that point, you then have to say, okay, given that there was nothing to prevent Lazy Larry from sending that presentation 2 days before the meeting, or from sending an email 2 days before the meeting, say, by the way, when we have a meeting, I'm going to talk to you about various products, but I'm not your financial advisor. Why should the courts say Lazy Larry and his bank are entitled to rely on those disclaimers? I don't think they should. I'm just waiting for the case with the right facts to go and argue that.
I'm sorry.
Yeah, of course.
Just maybe I'm not actually familiar with like the procedure at the bank
Okay.
as a customer. But I'm just wondering, what we have in the first paragraph it just says like Mary meets him and asks him. So I'm just wondering what we're talking about, that they had an official meeting at which he presented the products of the bank, and then half truth he gave her and half truth not. But if it's just a meeting, for example, it doesn't say that she didn't meet him at a coffee shop and ask him, oh, I want like a fixed rate, and he's like, well, you can actually sort it out at our bank where we have this product, and then like, for example, could it be the other way if that was like an actual, like if the Lazy Larry was actually trying to sell something to her, he would like, okay, hello Mary, this is our presentation, this is what we can offer you, and then like that will be a disclaimer. So I mean, we don't actually know if that was a formal conversation or not out of this particular task. So I would say that she can't rely on any remedies and can actually source anything, because obviously he sent her the presentation, and then the presentation was everything she was asking about, and then disclaimer, and then whatever happened before that, even if they had a meeting at a coffee shop or anywhere else, it doesn't matter, because they were having an informal conversation. As I see it, I might be wrong. It's just I'm not familiar with like how it actually happens in real life. If someone was the manager and gives advice, was it an advice, or was it like, I'm your friend, I'm gonna tell you this?
Okay, so what you're saying is it's possible to come up with circumstances in which the context of the meeting is such that Mary ought to know that she cannot rely on what the salesman is saying. And I think you're right. I think it is possible to imagine circumstances in which that's the case. The informal meeting at the coffee shop where he's buying his cappuccino from Pret, and she catches him in the line in the queue and says, "Can we have a word?" And he says yes and sits down. I can see that you could make that work. In practice, the way that these particular products were sold was you would have a meeting with your normal bank manager. Your normal bank manager would then say, actually, there's this special set of products. I'm not the person who can advise you about them. I will have to bring somebody in. And so you would then have a formal meeting. Now, what had happened with these products was these products were originally sold to sophisticated buyers who didn't need explanations because they understood them. And so the paperwork was very light and the paperwork was very late, because everybody who was buying these products had bought 10 of these products in the last 12 months. And so they didn't need to have all the paperwork in advance. But when the products shifted to being sold retail, nobody sat down and said, now we're selling these retail, we now need to think about, actually, we need to give documentation to people much earlier because they don't have the background. But you're right, the questions of reasonableness in terms of reliance and disclaimers and so on are going to be fact specific depending on the context of the meetings and so on. What about little b on question 2? Would your answer be any different if the paperwork with the small print was sent out a week after the interest rate swap had been entered into? We're getting nods. Why do we think so?
She's got into the main agreement already based on the advice that has been provided, and the paperwork is only being sent afterwards.
So what effect does that have?
The effect is that it's a move to exclude liability
Right.
by the bank, and in line with I think the Unfair Contracts Act, the way you explained it, it's something along the lines for her to claim.
Okay. Yes.
Essentially, it's a failure of, I would say, incorporation, because the information needs to be brought before the deal is finalized.
So the line you would run if you're on behalf of Mary is, I entered into the interest rate swap on the day I made the phone call. That's the day we formed the contract. So then the question is, what are the terms of that contract? The answer is going to be the standard answer. The terms of that contract are the express terms of the contract plus any necessary terms to give business efficacy, or any obvious terms. So what would we be saying about the exclusion of liability if you're advising Mary? You'd be saying those terms aren't necessary, they're not obvious, we don't need them, and you'd be saying if they only come a week later, they're not incorporated into the contract. Just too late. Yeah. Now, question C that's in there is touching on the ideas in relation to the difference between basis clauses and limitation of liability clauses there. And then lastly, if Lazy Larry knew at the time he spoke to Mary that the interest rate on a fixed rate loan was lower than the interest rate on the interest rate swap, what claim has Mary got against the bank? She's got a fraud claim. She's got a straightforward fraud claim. You're trying to tell me that this is better, you know it's worse. I'm suing you. I'm suing the bank for fraud. So what we have in this case is a double-edged bond. This is an investment product that does very well if the market improves. If the market goes badly and goes beyond 20% down, then you lose everything. So, Mr. Oily advises Leopard Leisure to enter into one of these double-edged bonds. What are Notorious Bank trying to argue when Leopard Leisure complains? No fiduciary duty, yes. What other duties do they say they don't have? Yeah. No duty of care. They don't owe a duty in relation to the advice that they're giving. how are they say? What's the basis on which? What's the on what grounds do they say they have no duty of care? Well, what they're saying is, we do give a financial advice, but we only give financial advice to certain customers. You have to be a VIP customer, and you have to pay an annual account fee. So they're saying you could have had us accept responsibility for financial advice, but to do that, you'd have to fulfill these conditions. Now, what do we think that is? Do we think that's a basis clause or an exclusion clause? Yeah, you think it's an exclusion clause? Yeah, you think it's an exclusion clause? He thinks it's a basis clause. Okay.
Basically, like here, they would say that basically they gave no advice except to the VIP customers because they signed up for the plan. So it would like create two different type of treatment: one between the people that are not VIP customers and the one that are VIP customers.
Okay. So we got a divided room so far.
I mean, the courts would probably see it as very unreasonable.
I think it's unreasonable. The question is whether you get to the question of whether it's unreasonable. I think that's the issue. I mean, I would want to know a whole load of more facts about this. For example, did Leopard Leisure get told each year, you're one of our normal customers, but you are eligible to become a VIP customer. If you want to become a VIP customer, you'll be able to get financial advice from us. It only costs £100 a year to sign up as a VIP customer. If you had all of that as the factual background, I might be leaning towards this is a basis clause. The Leopard Leisure could have opted in. It's chosen not to opt in. It can't complain about the fact that it doesn't have the benefits of the stuff it wasn't prepared to pay £100 a year for. If, on the other hand, the existence of VIP customers is something that is kept deeply secret, and it turns out to be that only people who've been on the yacht, luxury yacht of the senior managers of the bank get treated as VIP customers, and Leopard Leisure had no opportunity of becoming a VIP customer, then I might want to say, well, this looks and feels like an unreasonable exclusion clause. I think I'd need to know a whole load more facts about that. If you were advising Leopard Leisure and you thought, okay, we can't get home on a claim for financial advice, or at least there are risks because we're not a VIP customer, how might you frame your claim instead?
As local leisure, it is better to frame it as an exclusion clause because we don't have to show that the basis clause was unreasonable. Because exclusion clause have have to be subject to the reasonableness, but a basis clause you basically have to demonstrate that to courts, and it is far more complex. So as the customer here, it is better to frame it as an exclusion clause rather than.
Yeah, I agree with that. But if you can't say that if for whatever reason you're worried about saying I was given bad financial advice, what else could Leopard Leisure say had gone wrong here? I'd be exploring whether Leopard Leisure could say, I have been given wrong information about this bond. When I was being told this bond is a good idea because look how much of an upside it gives me, I was not told about the downside. Now, the facts that we're told is that Mr. Oiley didn't know that the investment would be lost in full if the stock market crashed. So we're not going to be able to get Mr. Oiley probably for fraudulent misrepresentation. But we might be able to say the information that Mr. Oily gave to Leopard Leisure about the way in which this bond operated, that information was negligent because he didn't have reasonable grounds for saying this is a brilliant product because he should have warned us about the downside risk. Okay, so Miss Keane is so impressed by Mr. Oily's advice that she goes to another bank, Monkey Bank, and tells her relationship manager that she wants to enter into a double-edged bond. This time she's warned about the risk that the stock market might fall, but is told that there is no risk of that happening. Now, what's happening here? Sorry? She's giving a forecast. Okay. What are forecasts? Are forecasts facts? No, forecasts aren't facts. What are forecasts then? Predictions, speculations, they are a form of opinion. Can you bring a claim for misrepresentation in relation to an opinion? So, you cannot bring a claim for misrepresentation where somebody has expressed an opinion and that opinion turns out to be wrong. The only claim for misrepresentation you can bring in relation to an opinion is a claim for fraudulent misrepresentation. If I tell you that I think that London is in France, that's my opinion, and I don't honestly believe that London is in France, my state of mind is a present fact. Whether I do or do not hold a particular opinion is a present fact. And so you can bring a claim for fraudulent misrepresentation if somebody tells you something and that is not in fact, the opinion that they hold. But if they hold the opinion genuinely and sincerely, no matter how ludicrous, that Trump is a great president, for example, that is not the basis for a claim for misrepresentation. Sorry, I should have said that Trump is a man worthy of the Nobel Peace Prize. That would probably be easier. Yes? Well, what you would be doing then is she would be saying, I thought that you were an expert, and I am not an expert, and therefore I was entitled to rely on your opinion as an expert. And that would then be a claim for negligence in relation to that. So you don't have a claim for misrepresentation, but you do still have a claim for negligent misstatement that is available to you. The question here is whether it's reasonable to rely on Miss Patient, because monkey banks say Miss Patient isn't one of our investment advisors. It's not her job to forecast the markets. What might you say in response to that if you're advising Miss Keane?
She may not be in a position to advise on the market. I mean, considering that the bank is labeling her as not a bank advisor to them. But given that she's an investment advisor to Ms. Keane, there's some form of negligent misrepresentation, especially because she knows that Ms. Keane is relying on her for information.
It's going to turn, isn't it, on whether it's going to turn on what Miss Keane reasonably assumes is Miss Patient's role. If it is reasonable for her to assume that Miss Patient is an expert able to advise on this or to pass on information from others accurately, then Miss Keane is going to be able to rely on it. Now, there's one other factor that this example is throwing up. This example throws up something that exists in theory in claims of this kind, but is seen relatively rarely, which is contributory negligence. That what has happened here is that Miss Keane has actually gone to Miss Patient with a bad idea for a product she wants to invest in. Now, the bank might respond and say, and you say this typically, the answer to this question is Miss Keen would have gone ahead anyway, in which case the claim fails entirely. That's what happened in Mars Limited against NatWest. They said even if you've been given the proper information, even if the representations hadn't been made, misrepresentations hadn't been made, you'd have done the same thing anyway. But it is possible in theory, and happened in one high-profile case I was involved in, where the court said, no, the person is liable, but there's a deduction for contributory negligence. Thank you.
Anyway, what his patient said also, we didn't bring this up, but it's also his patient gave basically reasonable, even if it was advised, because the London Stock Exchange dropping by 20% is like really like unlikely.
Yeah.
So maybe she's why she didn't bring this up.
Hey, how's it going?
Fine.
Hey, how's it going?
It's just like logged on Professor Walker. You can just log out.
Alright, cool.
How was your week?
Yeah, good.
You still didn't have time to read my mail, no?
I haven't gotten back to you yet, sorry. But yeah, tomorrow hopefully.
Yeah. Well, which course are you teaching now?
Securities regulation.
Oh, okay.
Yeah.
I reached out to some other Chinese universities for
Yeah,
research. I got some positive feedback as well.
good.
Yeah, from really good unis, so I'm happy. So yeah.
Yeah, good.
I hope.
Good.
Alright, thank you.